We're on Chapter 10, which is dealing with the valuation of early stage ventures. We're going to first look at Learning Objective 1, which is a review of the classic valuation models that we learn in finance, and then apply it to this early stage venture and describe the art and the science, which is Learning Objective 2. All right, some of the basics. Do you remember your fundamentals? You probably saw it both in your accounting and the finance courses, but let's go through in very quick fashion the steps, and then we'll do this by way of example also. The underlying valuation method for all of finance is that an investment's value is equal to the present value of its future cash flows. It sounds simple, but we use that for everything. We use it for stock and bond valuation. We use it for less tangible items like real estate, but we also use it for early stage ventures. So the steps are: first, analyze the actual financial performance, and that's to provide you a benchmark for where you came from. Notice that I'm not saying that the past predicts the future. That would be too easy. But the past does give us some indication and context for the future. And that's why we do extensive financial analysis historically, because it will give us some clues as to what might happen going forward. The second is look at the business plan for the future. Again, notice that I said business plan and not financial projections. You first have to understand the business plan so that you can see how that's reflected in the cash flows and the projections. So historical, knowing the future plans for the company and its state in the industry, then go to financial projections in the future. Once you have that, we can start using some of our tools. We can do the projection for a finite number of years going forward, and then we're going to use the last year as the stepping stone to predict what the future might look at till the year infinity. That's a long way out. So we use the constant growth formula. That's the most typical way to do it. And that determines the terminal value. The idea being that we ran it for, say, 5 years. And at the end of 5 years, we're going to sell it to the next investor or next operator. And they're going to pay us a lump sum dollar amount for the pleasure of running our wonderful business. So that's what cash flows look like. Operating cash flows and then a terminal value. Then we're going to bring the cash flows back to present value using the weighted average cost of capital. And we will then determine the valuation of the company, which is the present value of future cash flows, right? So it sounds simple. And the math actually is pretty simple. The interpretation is more complex. All right, we're going to do 2 examples just to compare and contrast. The first example is an existing company with some history, say 5 years, and some projections going into the future. We're going to then prepare the cash flow in a Excel format so that it facilitates our analysis to derive the net present value. So here we see on the graph the history, which are the dots right there. And then the future is here. These are projections with the high and low of showing the ranges of the expected outcomes for those subsequent years. On the bottom, we see the spreadsheet, and we're going to carry this forward into an Excel spreadsheet. So here we have the same spreadsheet, but now we're in Excel, so we could do our magic with it. So these are the cash flow for years 6 through 11. And then year 11 will be that stepping stone year. At that point, we're going to derive the terminal value. So I'm going to put the cursor there. And if you remember the constant growth formula, we take the next year's expected cash flow. So I go plus, and the most common mistake made here is that you take the current year, not the next year. So let's take the current year times, open parens, 1 plus the long-term growth rate, close parens. And if you just pause there, that's going to grow the 300 by 1 more year of 2%. And then at that point, we have the baseline for the constant growth formula. Then we divide it by the required return, in this case is 12%, minus the long-term growth rate of 2%. And that gives us a number, a large number of what we would theoretically sell it for at the end of year 11. That number would be 3060. Now we have cash flows. So we have the 100 plus whatever the terminal value is, and we have those for the period of time, the 6 years. Then we can pull the net present value. The old-fashioned method, we'll do the old-fashioned method first, is to take the individual cash flows and pull them back to time 0. So plus that number divided by, open parens, 1 plus the required return raised to the power of the number of years. Now notice that normally we start with 1, 2, 3, 4, 5. Here we have 6. So we're going to do something a little bit more complicated. It's 6 minus 5 is equal to 1. And doing it this way, we can then copy this formula across. Also, we notice that the 12% is an absolute cell reference, so let's hit F4 to make that dollar signs, making it absolute. This one should be relative. That's the cash flow for each year. That one should be relative. That's the year number. All right, so the first year, that $100 is worth 89. So now we copy that all the way through, and we have this string of numbers. Let's format it so it's a little bit easier to read. So the 120 is worth 86, and way out here, that 3360 is worth 1702. It's worth only 1702 because it's at a compounding where we bring the present value back for 6 years. So the net present value is equal to the sum of those cash flows. So that's 2202. Now, we could have done a shortcut using the NPV calculation. So equals NPV, and we start with the rate, which is again 12%, comma, and then we use the values for each of the years. And so here we'll take the strip of data, close parens, and we get the same number. All right, it better be because this is the same math behind it. Next, we're going to decompose the net present values. Did the cash flows from operations drive the present value, or therefore the value, or did the terminal value drive the value? So we'll do them individually, and I think that's easier once you see it. So first you say, well, what are the annual cash flows and what's the NPV? So we use our friend the NPV formula, equals NPV, open parens. The first parameter is the rate, comma, and then you shade from T1 to last year. So that's the cash flows just from running the business. So that's 651. Next, we get the net present value of a single factor, so that we can use the PV since there's only one cash flows, equals PV, open parens. What's the rate? 12%, comma. What is the number of periods? The number of periods is 6, comma. And what is the payment? There are no payments. It's just 1 at the very end, comma. 0, so 0, comma. And then you say, what is the future value? That is the terminal value, close parens, and we get 1550. I'm going to change the sign. So the sum of the cash flow from running the company plus the cash flow from the terminal value equals the net present value. So this had to equal, but what this does is it tells us what's the composition. So 651 divided by 2200 is, stated as a percent. So roughly 30% of the value comes from running the business. And the other side is, how about selling the business at the end of year 6? So 70% comes from selling the business after 6 years. Most of the value is derived from the value created by building a good business, but we get about 30% from running the business. So that is the first example of an existing company with 5 years of historical data. Next, we're going to say, well, what happens if we have a startup? Well, here we have maybe a few years of actuals for, say, 1, 2, and 3, but they're all low or negative. Next, we have forecasts for the next few years, from years 4 through 9. The WACC for the early period is 40% because we're a startup that has been losing money. But after year 9, when we sell it to someone else, we're going to assume that the next buyer will have a lower required return because we would have removed a lot of the risk from the venture. So the WACC will drop to 12%. The growth rate is 2%, and we can then determine the value using these assumptions. So again, we'll hop back into Excel. So the required return is, there's 2 periods, it's 40% and 12%, and this is early, and this is after year 9. In other words, starting year 10. So here's the cash flows that are the assumptions. We want to do the terminal value. Again, let's do this together. Plus, open parens, the cash flow for year 9 times, open parens, 1 plus the growth rate, 2%, raise, that figure divided by, open parens. Now here's the tricky part. It's the weighted average cost of capital for the next buyer, not you. So that's 12% minus the 2% again, long run growth rate, and we get a large number. And similar to what we did before, let's do our cash flows by year. And let's do an NPV equals NPV. We'll take the shortcut this time. And the rate is 40% because we're still in our early stage venture, comma, and we'll shade this area. Close friends. So 83,000. And here the decomposition of cash flows versus terminal value equals NPV, open parens, the rate is 40%, comma, the cash flow for operating the business, close parens, and that's 16,000, and then equals the PV, open parens, the rate is again 40, comma, a number of periods, which again is 6, comma, payments 0, comma, terminal value. And again, let's change signs, and equals the sum, and same number. So this number is the same as this number when it's the same number of decimal places. It's just formatted so it's very obvious. Okay, so now we've seen that this is a much bigger number, 83,000 versus 2, right? So you say, oh, it's a no-brainer. We should do the startup, right? So that's the simplistic view of doing a spreadsheet, first of cash flows, then determining the terminal value, then pulling it all back to time 0 using the weighted average cost of capital, and then that gives us the valuation for the entity, whether that's a startup or the existing business. So simple, right? Well, let's hold on a little bit. So let's do a little bit closer inspection of the two investment alternatives, let's say, of the existing business and a startup. First, which one has a higher weighted average cost of capital? The existing one had 12%, and the startup has 40%, dropping to 12%. So that is an indication that the existing company is lower risk. So which has a higher WACC? The startup, it's at 40%, and the existing is 12%. Well, there's a reason for that. The higher WACC represents higher risk. So that's a clue. Oh, it's not quite as simple, right? Because the WACC indicates the level of risk that investors are willing to take on those two different alternatives. Next, which one has a higher NPV? As we saw earlier, the NPV for the existing is about 2,200. The NPV for the startup is 83,000. So the startup has 83 versus 2. Next, does that make it better? Well, here's the trick question. The answer is no, not necessarily. So let's look at the following things. Let's look at the annual cash flows for the existing companies versus the startup. This is before we do any projection. This is the history of the existing. Notice, first of all, they're all above 0, and it's showing a slow but steady growth. If we do the next one, and we do the same idea, we go, oh, we show a lot of negatives. So the 3 years of actuals are all negative. So that's not very promising. So when we make this very simple first observation, well, the existing one has made money every year, even though the growth is relatively small, versus a startup, which has never made money. Oops, never is not a good thing. Next, how about the progression? Looking at the changes from the actuals to the projections. And here our projections go like this. Growth and a little bit of acceleration out in the outside year in year 11. Okay, I got that. How about for the startup? Well, we go from losing money to still losing money to then all of a sudden going like this. This is what we call a hockey stick. A hockey stick is like that, right? That's more dramatic hockey stick. But this shows that same pattern of stay with me for a while, where I'm making no money, losing money, then making a little money, then more, and then boom, I make a lot more. So here, the pattern is that the existing has a smooth upswing, and then startup is more of a hockey stick in the final year. Next, the variation from high to low in terms of the projections made by the company. The high to low range are these little amounts. Again, these are projections, so we have to be skeptical of all projections, but this is kind of the range of variation between the expected case, the high and the low. Well, what is it for the startup? Well, it's starting relatively small, but then we get these very large variations, particularly in the critical last year prior to us selling the business. So the answer here is that there's much less variation in the existing company compared to the startup. And how dependent is the net present value on the terminal stage? In the first case, as we mentioned, 70% of the existing company's net present value is from selling the company. That sounds like a lot. However, when you look at the startup, 81%. So put it very bluntly, you're betting everything that the company that's a startup will be worth a lot of money at the terminal value. And you're really not expecting any value for you as an investor coming from holding the business. So that gives us a more complete picture, is that, yeah, there's a higher WACC for a reason for the startup because it's high risk. It has a higher NPV because we have very optimistic assumptions about where it's going to go. And there are indicators as to why it looks like higher risk. First, the actuals for the startup are negative. Secondly, the progression is more of a hockey stick. Next, that the variation of high or low is wider because we're less certain as to the outcomes. And finally, we depend a lot on the exit event. So this is the nature of investing in a startup. It's high risk, high venture, not a lot of cash flow. We're really betting that this works and we're going to create something very valuable. That's one of the early things we mentioned in the principles of entrepreneurial finance, is that everyone is betting on building the company's enterprise value. And this illustrates it through some math. Next, we're going to look at what would happen if you're confident. If you're confident in a business, how would you value that as a pre-revenue company? So here we have this idea that we have part art and part science. The part art is at seed. We have very little certainty in terms of projections or even product or customer acceptance or competitive reaction. So we're really guessing a lot on, or relying a lot, I shouldn't say guessing, I guess, but relying a lot on our judgment and what might happen. As the company progresses through IPO and to maturity, it becomes more scientific. We have a lot of history, a lot of stock price and market and industry and competitive data. So it becomes, of course, there's always judgment, but we now have a lot more data. We can be more scientific in our valuation of the company. And so at startup, what constitutes art or judgment? Well, there's the concept or idea and your assessment of how good it is. Next is the team. You're evaluating the caliber of the team. Can they really deliver the promise of this company? The market size, is the sizing correct? The competitive position, you're having a certain estimation of how strong your product or service is compared to the competition. Is that right or wrong? Next is that your advantage, your innovation, creates a sustainable or an unfair advantage where it's very difficult for anyone to bump you from your lead position. Next, that there's a prototype that is either there or soon to be there that will catch fire with the intended target audience. And that we have strategic relationships that every company needs, and that as we need them, we can get them. And those will propel our progress moving forward or reduce our risk in terms of competitive threat. And customers, that they will buy and they'll be loyal and they'll repeat and they'll tell others about it. And finally, that sales come as we estimate. As we mentioned before, sales is the toughest projection, but we're going to have critical sales assumptions as we build our financial models. So at startup, when we look at this art and science, then we're going to introduce now the venture capital method. And this very elaborate graph shows just what a VC encounters from cash flow. They have one large cash flow at the exit and one, I guess I should have shown, the negative cash flow. So they have a negative cash flow at time zero, their investment, and one large cash flow at the end. And just by way of example, we've done this in class also. If the exit is $100 million, and if the original investment was $10 million, and the required return is 40% per year, then the 7-year time frame leads to the present value of 10, right? This is the 10x that we talk about. is that embedded in that shorthand phrase of 10x are two things we use all the time, and that is that we expect to have an exit in about 7 years, we expect a rate of return about 40, and by doing so, we can meet the parameters of our investment objectives to our limited partners for the venture capital firm. So that's where 10x come from, and 40%. And that's roughly the high risk, high return relationship born in the expected return from a venture capital investment. So summarizing, for valuation of early stage ventures, we have the basics. We can use our classic approaches, but we know that the projections are very tentative and there's a lot of uncertainty, but we can still apply the tools. Secondly, note that there's a lot of judgment or art in the development of the assumptions for the valuation models. For your information, in the next chapter, chapter 11, we're going to be going through a lot more on valuation, dilution, and the capitalization tables for companies. And this is kind of the heart of a lot of venture finance.